Hey everyone, I'm Jen with Blockchain Banter. We had our part one this morning, Mastering the Markets, Trading Crypto. I'm here with Dr. Mark Richardson of Bancor and Carbon DeFi. He had to jump a little bit early on the previous call. We were going to pick back up next week, but then I got a little sneak peek at what he was going to share with you. Way too good to not jump back on right now. So you can really get an idea of what it is we were talking about and how you can apply what Crypto Choreo and Keith were saying on chain using this product here that Mark is going to speak about a little bit. Mark, thank you so much for jumping back on with me. I really do appreciate it. I see you're sharing your screen. So maybe just tell any of our new audience members, any new listeners, viewers, what Carbon DeFi is and how they're able to achieve certain things through this product that you've created here.
Sure. So yeah, Carbon DeFi is an on-chain trading protocol. It is a decentralized exchange, but it's not an AMM. And I think that the difference is significant enough to comment on, because with an AMM, you are providing liquidity to a specific type of trading strategy. And sometimes those trading strategies can perform okay, but in general, and especially during an uptrend, they tend to not perform okay, especially if you are providing liquidity with something like a stablecoin at the beginning of a bull market. Generally not a good idea. But one of the things that I wanted to bring to sort of the trading discussion in DeFi is that a lot of the trading that people do is I would say artificially limited by their choice of the tokens that they trade with. So I would say it's fairly common for people to denominate stuff in a stablecoin, which is okay, like during a crabbing market, if you're trying to scalp the charts, or versus ETH. But that's also pretty limiting. One of the I think with some of the insight that we get from Choreo, it's pretty clear that different tokens sort of under the same category tend to perform well or tend to fail together. And I think that's worth taking special note of, because there are groups of tokens that you can trade against each other, that even during a very strong uptrend, you can still profit from, without taking a huge downside risk if your portfolio ends up emptying into USDC or USDT, which is generally the case on many like concentrated liquidity protocols, for example. So yeah, Carbon DeFi is really supposed to be that answer to the lack of offering when it comes to trading different tokens versus each other. So even with concentrated liquidity protocols such as Uniswap v3, which I think is a totally respectable protocol, there is still this impetus that the magnitude of the liquidity of the pool will somewhat determine its performance, and this is true for that specific type of trading strategy, because the short gamma that it represents is very much contingent on enormous trading volumes to make itself sustainable. But there are other ways to trade, and Keith and I are a very big fan of scalping. So sell when things are looking overbought, and buy when they're looking oversold, and profit from the difference. And Carbon is very much built with that in mind. And one of the questions that I have fielded really frequently, even during the development of Carbon, is that sure, like it trades really well when things are moving sideways, but what about during an uptrend? And this is why I wanted to get back on the call with you and demonstrate what Carbon is capable of, because I was inspired by Choreo and sort of the pre-call chat when I asked, what things are trending well, and he said like the meme narrative is still going really well. And so what I've done is to prepare a couple of tabs, and we're going to look at a couple of different meme tokens. But maybe before we do that, let's just have a quick look at the app and how this thing operates. So it's relatively simple. You connect your wallet as normal, and you can create a strategy. Now, a trading strategy is just like creating an order on Binance or Coinbase or something like that, with the with the caveat that you are able to not just create single limit orders, meaning selling all of your liquidity at a single price, but you can create scaling in and scaling out strategies that you can fade between as the market moves in and out of your price ranges. So I'm just going to put up a relatively uncontroversial pair just to sort of get people acquainted with the protocol if they haven't seen it before. So something like ETH/USDC is obviously a very common trading pair, but as we're about to see, the price for this on longer time horizons is is in a very strong uptrend. And so during these kinds of market moves, what a lot of people in the space will tell you is that this is a time to hodl. Trying to scalp ETH when it's making moves like it is now can be very dangerous if you're doing it on intermediate to longish time frames. Sure, you might be able to scalp it on sort of the 5-minute or 1 hour level if you're doing it with small amounts. But it's not the kind of thing that you want to be entering into and exiting from large amounts of your portfolio, just because in general the market is going to continue to trend up. We heard from Corio in the call that he expects the market will just continue to trend in the direction it is, that it has a lot of bullish strength behind it, and I think that he's right. But Keith and I are also very strong advocates for the cautionary tales of 30%, 40% drawbacks even during a bull run. And so the point that I'm making here is that something like the ETH/USDC chart during an uptrend, you can trade it. And if I was convinced that I wanted to sell ETH when it got to a very high price, like I don't know, maybe my friend told me that it's going to go to 20,000. I could just set this sell high and put my ETH in here and set it and forget it and come back, and if the price gets to 20K, the protocol would have sold it for me. So this is I would say a very respectable way to use Carbon, just as a normal limit order machine. But where Carbon really excels is trading exotic pairs, and it's because of that exoticness that you can combine tokens that wouldn't usually be offered even in a centralized exchange. And so I wanted to show you a couple of really good examples of that. So on the meme token front, you can see that this is SHIB versus USDC has made a very sort of hockey stick shaped move to the upside. And it's not the only one. Floki, which is, I guess, its sort of companion token. It's never been clear to me if these are both belong to the same project or if they're competing projects, but it doesn't matter. The point is that their charts are pretty untradeable versus USDC. Maybe for a while back here we could have achieved something, but very, very difficult to trade this versus a stable coin when the market is making these kinds of patterns. And so the question then is, do you just not trade it? Like, are you forced to hodl your Floki and Shiba Inu, or can you do something more productive with it? Another good example is Pepe. It's a similar looking chart, but not the same. And the fact that there is sort of a close agreement or sort of correlation between these tokens suggests that you can trade them against each other, even while you're riding the market to the upside. And so that's what I wanted to demonstrate today. And so I've got the rather than trading Pepe or Floki versus USDC.
Interesting, right?
Yeah, we trade them versus each other, and you can see now, like it's not this hockey stick shape, because we're measuring the price of Pepe in Floki. And because they both kind of made a similar market movement, because you're only taking exposure to one of these coins or the other as it trades, you can still sort of ride that wave up. But when you look at the fine structure, you realize actually this is a very scalpable type of chart. And this is going back a little while now. So this is going back into May of last year. And as you saw, we started to get that hockey stick shape only recently. But because they both did it at roughly the same time, their chart is still relatively sideways. And so this is, in my opinion, like Carbon's strength, because you can set your buying and selling prices wherever you like. And you don't have to be a genius. I know a lot of people that sort of get intimidated by the fact that they have to make a choice. But I would say that having seen this kind of this pattern developing, it would be non-controversial to say, well, look, if these things continue to move together, even if they go 100x or 200x or whatever it is meme tokens do sometimes, then it might move out of range occasionally, and maybe you'll be taking a little bit of downside, or it might move up or whatever. But so long as it keeps kind of following each other, as long as these two meme tokens have a very similar profile, then trading them against each other on Carbon can be a really excellent way to profit from market moves. And so what I'm doing here is I'm using the simulator resource, which allows us to backtest certain strategies. So again, we're starting back in May, and we're going to take it up to the present day. And I'm just going to see like what would have happened if I had chosen to trade these two tokens against each other, such that I am buying Pepe with Floki as the Pepe price moves down relative to Floki, and then I'm selling my Pepe as it moves up relative to Floki in this band. Now, because the simulator is starting sort of way down here, I'm going to start my portfolio with just 1, 2, 3, 4, 5, 6, 7, 8, 9, 0 Pepe, which is like about $10,000. And so we're expecting to sell as it moves up through this part of the simulation, and then we'll buy it back over here, sell a little bit, buy a little bit, sell a little bit, and it's this buying and selling where you're constantly buying low and selling high that you manage to compound your returns, and this really accelerates the portfolio performance. So let's have a look at how this performs. This is very, very quick. I used to have a version of this that ran locally in Matplotlib, but it was very, very slow, and the wizards that I work with have helped to build it into a web app that's now very responsive. And so what's interesting about this simulation is that, remember, this includes the enormous market movement that we've seen. And it's measuring our gains in the tokens that we provided. So this ROI, this isn't 112.85% versus US dollar. This is 112.85% versus Floki, which did that hockey stick shape. So I know I didn't see what those returns were, but let's just say that it was a modest 10x. This is 112% on top of that 10x. And again, it's not, there's nothing weird going on here. This is just trading these two tokens against each other as they move up. Now, it's not risk-free, right? There's no such thing as a risk-free deal. And you can see that as we're looking over our performance versus HODL, that actually during this move up, we actually had to weather a negative 40%, versus HODL, meaning that as the price of Pepe was moving very, very quickly, and Floki was relatively stagnant during this particular phase of the market, when we've loaded up on Floki, we would have done better just by HODLing. But have a look at what happens next, right? Because even though it's kind of bouncing around and our strategy's not doing so well, over time it does improve, and actually it improved quite dramatically. And after about September of 23, this particular position just kept going up and up and up, and so finished with a 112.85%. The simulator gives you this animation, which I think is really helpful for sort of getting a good heuristic for how Carbon behaves and what it's actually doing. And so I kind of I treat this as like a test drive, like for getting my bearings, in what the protocol is actually doing. We also get the summary page where we can have I guess a complete snapshot of what the strategy was doing. And this is, I think, a much better way to visualize what it was I was just speaking about. So if I turn off everything except the HODL value and the portfolio value, what you're seeing here is what is generally referred to as impermanent loss, which is that the HODL value of our LP position would have actually been worth more had we not provided liquidity with it or traded it. Whereas our portfolio value goes kind of flat here. So the difference, the delta between this orange trace and the blue trace is essentially our losses. But when the blue trace goes above the orange trace, this is when our trading position, our LP position, is now outperforming the HODL position. And what's interesting is that, contrary to what is typical with AMMs, during that hockey stick shape period, we actually started to get much more significant returns just because these things were relatively flat versus each other, but with an enormous volatility profile. So there's a lot of opportunity to scalp the price difference. Now, I've prepared another simulation, which is Pepe versus SHIB, which is a very similar chart, but not the same.
Mark, before you move on, can I ask you a quick question?
Yes, of course.
I noticed that you only added a budget to your sell order. So you only provided Pepe, you have 0 Floki there. But if you wanted to, you could provide, I mean, this is an option for the users, right? You can fund the buy order or the sell order, or you can fund them both. And
so it's dramatic. Yeah, again, this is another dramatic difference from conventional order books, because I'm creating a trading strategy, not just an order. And so even though I've got 0 Floki here, this means that this green region won't have any tokens in it. But when the price moves up through our asking liquidity, this means that we're now converting Pepe into Floki. And that will fund our buy orders on the downside. So you can kind of create orders with money that you don't have yet, so that when you do get the trade that you're hoping to get, that it immediately funds the opposite side of the position, and sort of recycles that, recycles your profits, into the trading strategy itself.
And that's at no expense to the users, right? It's native to Carbon DeFi, and like the automation aspect of it, the rotating of the liquidity, that's native.
Yeah, it's just a natural expression of the smart contracts. So you do have to pay a gas fee, as with all smart contract interactions, but you only have to do that once. So with this strategy that we just finished, the
cost would come at the time of creation, right?
At the time of creation, and then we're simulating a trading strategy without modification for almost a year. So it'll be, change in gas at the front, and that's it. All of the trades that it makes, it's the taker that is that's participating with you that has to pay the gas to trade with you. And so no, you don't have to pay an ongoing gas cost or anything. And you can see that we're making a lot of trades. So if you were doing this on spot, that would eat into your Ethereum position. But here, it's gas free so long as you don't touch the position after you set it up. But of course, if you want to touch the position, you can touch the position. You can always come back and modify these ranges if the market changes, or one of those tokens starts doing something you don't like. It's very easy to just pause, so you don't even have to make a decision about how to continue trading. If you want to, you can just say, please set all of my prices to infinity so that no one trades. And then, later when you've made up your mind about what you want to do, you can come back and switch it back on. Or if you already know what you want to do, you can move these prices around, swap it from limit to range, all of that jazz.
Without having to withdraw your funds and recreate a position.
You can withdraw your funds if you want to, but you don't have to. And
right.
sending tokens around, but between smart contracts and user wallets is also a gas expense. So sometimes just leaving it where it is and deciding what you want to do with the trade later on is more economical.
Right.
So let's have a look at so the last simulation we ran was Pepe versus Floke. Let's have a look at Pepe versus SHIB. So again, you can see that I'm funding my position with just a bunch of Pepe, like $12,000 worth. And this is going to sell as the price of Pepe rallies, but then as it capitulates back into our position, the SHIB that we bought with that Pepe is then going to become available to rebuy that Pepe on the downside, and we're basically recycling the liquidity around. So I'm going to put 0 in here for SHIB and simulate this one. And so the interesting thing about the Pepe SHIB is that these are both like have performed enormously well. And so to get a 34% return over this period on top of the hodl position for that token position is phenomenally good. And again, it's not without some like having to withstand some downside sometimes, right? Again, I'll turn all of these things off except for the hodl and the portfolio position. You can see during that Pepe's parabolic rise, SHIB wasn't quite catching up to it. And so we took the trade as Pepe continued to rise, right? Which is the same as, if you decided to sell your Bitcoin today at 70K and then saw the price of Bitcoin go to 90K tomorrow, technically, you're in impermanent loss. Even though you're not using an AMM or anything, you can have impermanent loss just by making a bad trade one day and wishing you had held on a little longer. Impermanent loss has a lot in common with seller's remorse. So yeah, during this period here, when the yellow line is above the blue line, this is your seller's remorse period. And whenever the blue line is above the gold line, this is when you are trading profitably. So what's interesting about this position compared to the last one is that in the last one, the trader was technically underwater for a little while longer, right? I remember they were underwater up until the end of September of 2023. But in this case, the underwater periods were much more muted, so not nearly as much downside exposure, but also the upside was not as dramatic. So in the last one, we saw something like a 50% or 40% capitulation in terms of the portfolio value versus hodl, but with like 120 something percent or whatever it was overall portfolio performance by the end of the simulation. And here, even though the downside potential is significantly lessened, the overall trading strategy didn't actually perform as well. So this is, you have to imagine yourself in the position of having, actually set up this strategy and watching it operate, because you find like a lot of people will start to get concerned when they see the token that they just sold continue going up and things like that. So you have to remember like why your strategy exists and why you set it up in the first place. And I think Carbon lends itself really well to that kind of disciplined trading, rather than shooting from the hip, emotional, reactive kind of trading. Not that I'm necessarily critical of either one. I know a lot of people that do gymnastics through the charts every day, and they do quite well. But in general, it requires a special kind of person to trade well that way. Emotional decisions are usually the worst ones and the ones that we regret. So committing to a strategy is not necessarily a bad idea, especially if you've got specific price targets in mind, and with the flexibility of being able to quote one token in any other token. The other one I wanted to set up was one that actually is looking pretty good versus a stablecoin, right? So again, with the meme coin narrative, not all of the meme coins have yet made this hockey stick style shape. And so I'm looking at a token that a friend of mine likes to trade a lot called SPX 6900. And we're going to trade that versus USDC. And you can see that this is actually a very attractive trading pair. So where Carbon DeFi really excels is when you get a lot of this kind of up and down in the charts, because it means that you get more opportunities to buy low and sell high. So we're looking at a fairly healthy spread. You would be pretty hard pressed to get this kind of scalping action out of like Bitcoin, for example. And so again, the price of this starts way below my ranges. So I'm funding this specifically in SPX, just to see how this would have performed if I was setting up the strategy at this point in time. And so we'll put 0 USDC into this. And you can see that this is performing phenomenally well.
Incredible.
And this, yeah, right. This is a really, really great meme coin, not because it's doing the hockey stick shape, but kind of because it's not doing the hockey stick shape.
Because it's not, right?
Yeah, right. Because people will, I think the arguments that I made for trading things like Floki versus SHIB are compelling. It is very hard to trade something that starts to make that shape. But the risk that you're taking is that if if one of those coins suddenly becomes worthless, as is sometimes the case with meme coins, and I don't think that that's going to happen to Floki or SHIB in any dramatic fashion. Certainly not very quickly. But sometimes that kind of stuff does happen. And so with something like SPX, because it's not making such dramatic, impulsive moves, but it still has that kind of meme coin volatility, trading it versus a stable coin actually can be a pretty good idea. And yeah, in this particular case, it's a phenomenally good idea. This is a 250% return measured in USDC. And if we check the summary, you can see that again, because we kind of missed the train, as one does, when this thing started going parabolic, we did actually have a significant, or we did have to experience a significant downside. But what I want you to pay attention to is, people kind of do this like look back and they think, oh, if only I had sold the top,
Always.
like if I could just go back in time, I would have sold on this block, and made, 10x on my money or something like that. What's interesting about this is that you'd quite demonstrably missed the top, so you're in 100% USDC at this stage, and SPX is going nuts. And so we missed the top, but when the price came back down, we started buying it again, and then we sold it again, bought it again, sold it again, and so on. What's interesting is that because these traces are essentially one-to-one, right? This is just your portfolio value if you didn't trade at all versus your portfolio value trading in this particular strategy. What's interesting is that by the end of this process, you actually have more money than had you sold at the exact top, even though this is in a very strong, well, not a very strong downtrend, but in I would call this an accumulation phase. So you had this impulsive move, you missed it, maybe you feel some regret, but the trading strategy in the long term has actually outperformed selling the top, even though the price of the token is basically crabbing sideways. And this is the kind of thing that I think Carbon is appropriate for. These arguments about you should only hodl, or we only you only trade on a certain indicator or something like that. I mean, those things are all fine. I'm certainly no one in crypto is critical of hodling, but I'm just saying that actually trading can be made sort of more natural in crypto terms, because you aren't forced to look at the price chart through the lens of the US dollar. So for example, if we go back,
I think that
we go
that's
back.
something I was gonna ask you. Where else can you find a SHIB Floki, or, I don't remember the exact pairs,
Yeah,
Pepe Floki, Pepe SHIB. Like, where else can you find that chart with that trading pair?
yeah. I mean, pretty much nowhere.
Nowhere.
Yeah, this is all a part of our own backend implementation. And I remember being so frustrated because, I've actually traded this way for a very long time. And of course, I'm always beholden to the exchange that I'm trading on. And so if they, if they only offer something like a USDT pair, which was pretty common, then what I would be doing is like exiting from one position into USDT and then getting into the other token that I was really trying to
Right.
trade against by swapping my USDT back into that token. And it actually it adds up. There are always fees
It quickly
for
adds
doing this
up,
kind of thing. It very quickly adds up.
especially because the way
Um,
that you've created this here, if I may, if you were going to be, you know, creating a sort of range manually, right? Like, you're talking about spot trading, right?
right.
So it's one specific price that you're going to have four different trades involved. Never mind creating this sort of range made up of all of these separate sorts of orders or trades within that. So you are saving yourself an incredible amount of not just steps, but gas also.
Yeah,
Because not only is there no, I mean, there's no gas fees involved, like you said, like network gas fees for this. There's no fees at all. Like, what you just showed, that was a huge amount. I think it was 250%, something like that, in like 6 months, right?
right.
So the only
Yeah,
thing that they're
exactly.
paying for is the gas to create that strategy, and then that's it. So it's the creating like this unique trading pair, being able to identify it, right? I mean, I think that that's huge. Being able to identify the unique sort of trading pair and then back
Or
test
just
it and then have this
or just
one gas cost.
or just even ask the question, like, what would this like how would this have performed? That's
Right.
that's why I wrote this thing, um, you know, back when we were still developing Carbon, was because like I was convinced that this is a better way to trade, compared to traditional liquidity provision.
Well, I
But
definitely recommend everybody checks out the simulator so that they can kind of see this for themselves, right? Because this is public. This is
yeah,
on
this
the
is
Carbon
public.
DeFi app. This is what CarbonDeFi.xyz/simulate, right? So they can experiment themselves with different unique trading pairs and see how they would trade against each other.
Yeah, exactly. And
Yeah.
there's so much to learn about the market, because I think we're so conditioned to valuing everything in US dollars, and for good
Yes.
reason. Like I know why that's the case, and I'm not saying that we shouldn't do that. I'm just saying that if we're in a trading specific context, sometimes it makes more sense to be examining the volatility of tokens in other tokens when they're in the same class. So, for example, I've got two DeFi tokens here. 1inch is one of the charts that I like to put up all the time. Maker, I don't think I've ever done before. But you can see, like, this, you won't find this chart. Like, you can't go to TradingView and say, hey, what's the price of Maker in 1inch, please? But you can here. But more than that, you also can't ask the question of, how would this specific trading strategy performed, and this kind of thing. So what we're going to do here is I think we've done a lot in that direction. Let's split this thing upside down. I also really like that you get this kind of agnostic, UI that doesn't tell you which way these tokens should be around, right? If you want the token price denominated with 1inch, or if you want it denominated with Maker, that's your business. So let's put in some Maker here. I'm not sure what's a reasonable amount. Let's do $30,000. Why not? We're going to put in 1inch just because at the time that we set up this trading strategy, it looks like we were expecting the 1inch price to decline versus Maker and then trade somewhere down here. So let's start the simulation there and see what happens. See, much better. And again, this is 90% ROI in Maker, in terms of Maker. And it's worth pointing out that, we were holding Maker this whole time. This thing didn't trade for months, right? This strategy simulated was set up to begin trading back in March, and it didn't really make its first trade until August of that same year. And after it made that trade, let's have a look at the summary. The portfolio did take a hit, but it was relatively short-lived. And look, as it started to form this, what you would characterize, I guess, as like an accumulation pattern. But that's probably a misappropriation of the term, because you can't really call it accumulation because it's such an exotic trading pair, but it doesn't matter. The result is the same. You can apply the same type of analysis. So we did get a portfolio did take a bit of a hit. It then recovered and it never looked back. And we ended up with a 90% ROI, even though we didn't trade at all for almost a year. And then between September of 23 and March of 24, we managed to effectively double our Maker position, which is it is phenomenal. But yeah, I am an advocate for like learning to trade in tokens other than USDC pairs or ETH pairs, because things that are in the same category together, they tend to sort of move together, and being able to trade them in sort of these these sideways patterns is just so much easier when they behave similarly.
And this is any standard ERC20 token, right?
This is any standard ERC20 token. It generally helps. So for the, it's a marketplace like any other. Just because you're putting up a price doesn't mean that anyone has the obligation to trade with you. And so it does help if there's like lots of liquidity for that token. So for example, if we were to choose some, brand new meme coin that no one's really heard of yet, and you saw the price on CoinMarketCap or something going crazy, it's not clear whether or not the on-chain activity for that token would be as productive. So while it is true that you can trade literally any ERC20 token, my recommendation personally is to try and use the ones that have been around the block a lot. I'm not talking, it doesn't have to be $100 million market cap things. It can still be very low market cap coins, which is I think even more even
nicer, because you're not depending on the liquidity and stuff like that, and like the traditional sorts of pools and things, right? This isn't reliant on that.
Yeah, because with the really low market cap coins, when the liquidity is very thin on the ground, you're subject to you generally have to set your slippage tolerance very high when you're using a conventional AMM, just because any trade tends to move the price quite a long way, and this makes you more susceptible to things like sandwich attacks. Whereas when you're trading this way, you kind of are letting the market come to you.
You're making that flip, the taker in the system.
Make a taker reversal.
Mm-hmm.
Yeah, Stefan and I have written about this before. And it's something that in a lot of circumstances people are already doing, even if they didn't realize it. But yeah, this is just making it explicit, and I don't think it's a huge re-education. It's the same thing that people are always doing, right? I feel like people set mental limit orders. Do you know what I mean? Where they're like, at this price, I'm going to go to my computer and sell this thing. It's like, why would you
whether they
do
do
that?
or whether they do or not, though, is another story. But
well,
this is kind of a way to be able to do it, to say like this, that's it. This is where I want to sell. Because the thing with Carbon DeFi also is you're showing us these recurring strategies, right? These recurring orders or linked orders with that liquidity rotating. But it's not the only sort of trading that you offer, or that is, offered to your users. Just now you were talking about, at this point, I want to sell. If they want to create a simple limit order or they want to create a single range order to scale out of a position, they can
Right.
do that just fine. They're not obligated to this sort of back
Yeah,
and
yeah.
forth cyclic trading.
Yeah, we can do that as well. So yeah, like for this one, so this is TBTC versus Maker. TBTC is like one of the best wrapped Bitcoins on
Okay.
Ethereum. And we're gonna use TBTC as the numeraire rare asset. So that's the thing that we're using to value our Maker token. And what I'm going to do with this simulation, just because it's a really convenient one to do it with, is that, a lot of the time, because, I like to see how high I can get the profits, I'll like, put things like way down here and try and buy as low as possible and try and sell as high as possible. But realistically, if you saw this chart pattern today, like, where would you set your strategy? Like if I move these bars out of the way for a second, you can see that we're sort of coming back into this kind of zone here between about 0.3 and 0.4. And we can see we've been there before as well. And so rather than sort of maximize the strategy performance by exploiting the knowledge I have of being able to look back in the charts, instead, I'm going to say, well, what if we simulated what it would look like to have sort of imperfect knowledge, and like, how would something just like this work? And while we're there, why don't we set this up as just a straight limit order instead? So rather than having this full price range, we're going to instead have just a single price, or very close to a single price on both.
And you could adjust those on the left also. You can just enter in your prices.
Yeah,
there
we could
also,
do that.
right?
Yeah, we could do that. The difference is de minimis, so I'm not going to take it too seriously. And just like the numbers I put in here, like, we're just making these numbers up.
Throwing them out there.
If I did this with one maker, it would give me the same percentage return as if I did it with 100 maker.
Right.
It doesn't really matter. Yeah, and we'll do 0 TBTC, because at the time that the simulator is beginning, it wouldn't make sense to have bidding liquidity this high up, because it would just get arbitraged. And the simulator knows when you're doing that and kind of corrects for it, but I still like to do the simulation the correct way. So this isn't too bad at all, right? This is a 28% return denominated in Bitcoin. Like, that is, that's, I think, a phenomenal return, because Bitcoin
How long
has
was that
gone
over?
absolutely parabolic.
That's
Yeah,
over
so this
a year?
that's over a year. So this is beginning from the 5th of June, and running up to, it looks like it's got cut off a little bit there. But yeah, I think this is running up until, this is March. Yeah, so this is, about a year, slightly less than a year. And so Bitcoin, over that year, has managed to rally from something like 16K up to 70K. And most people would have just been happy to have bought that low and held Bitcoin till today. But actually trading it versus Maker was even more profitable.
Because you gain one. Well, I mean, with the amount of Maker, right?
Yeah, but yeah, I mean, we're denominating it in Maker, but you can see that this,
Right.
even though this chart has gone up and down a lot, it's still sort of just headed sideways.
Mm-hmm.
But yeah, it's a 28% return no matter how you cut it. But we can flip this thing upside down and see how it would have performed if we had denominated it in Maker. So in this situation, we're now, it's 0 TBTC on top, and let's put some, let's say 12 Maker in the bottom. And so this is now giving us a 62% ROI measured in Maker. Now, the reason for the difference there is just because Maker hasn't performed as well as Bitcoin has, right? But it doesn't matter, right? This ROI is calculated with respect to whatever you put your cash asset in. So they both perform well. It's just that, if you're measuring your portfolio in Maker, then the number is slightly higher, just because Maker is worth slightly less than it was at the start. But if you measure it in Bitcoin, a 28% return over a year is still nothing to scoff at.
Not at all. No. Mark,
Especially
thank
if you
you.
only have to pay the fee once.
You pay the fee. I think that that's what is really, really impressive. You pay the fee once, the rest of it is automated. The reason I was asking about it being automated was because, like, it being native to Carbon DeFi is because you can have third parties that would kind of recreate this sort of automation for you, or, implement this sort of automation for you. But that's a cost and that's a risk, right? Having it native to the protocol eliminates that extra risk, that third party risk, and obviously that cost as well. You're not paying that cost at all to a third party or to the protocol. This is just how it performs.
Correct. And like the strategies are still horizontal bands. And I've discussed on public calls before that I have designs for sloping bands and things that if you really want to denominate something in USDC, it is possible to trade it that way. It's it's, I think, a slightly less compelling product, but it is technically feasible. But I still think it's the wrong attitude. The attitude that you should have is, what are the best two tokens to trade against each other? Not what is the best token to trade against USDC. Do you know what I mean?
Right. Right. Well, and it's two tokens that you can be super bullish on, where it's like, okay, you know what? I'm out of this one, but I just doubled this one.
Right, exactly. And this is what, so, way back from the simulated development days, people know that I trade compound versus Aave, right? This is something that I've been
Right.
doing since I found out what these protocols were, way before I was, actually working in the industry. And it follows a very, very predictable band. And, occasionally you get these ridiculous moves in one direction. And, this is a good reason to never commit your entire portfolio to a specific trading strategy. But having something like this, like, I wish I could have been automating my trades on this particular pair for the last couple of years, because it's just so predictable. So let's have a look at that. I'm going to start this with zero compound, and let's say 1, 2, 3, 4, 5, 6 Aave. This isn't exactly where I kind of set my price targets at. But yeah, it's actually, this is pretty wide. But yeah, you can see that again, your downside, especially on this pair, is generally very limited. So this is only like a negative 5% that this thing experienced, and it generates a fairly consistent upside. So yeah, that's it. That was all the IL that was ever experienced on this position, was when the portfolio ended up in a lot of compound as the prices of Aave went up back in August of 23. But when it came back down and when we started trading it again, this the value of this position started to pick up very, very quickly. And I think it's always a good idea to go back and then sort of have a look at the strategy in the opposite direction, just to kind of show how arbitrary it is how you denominate your thing, right? The thing that matters is whether or not you're catching lots of opportunities to buy low and sell high. So we'll do one more and then I'll get off the call.
No, I appreciate you doing this with us and kind of giving us a better understanding of what we're able to achieve using the protocol, and by not even just using the protocol, but by not denominating everything in USDC or USDT, whatever stable of choice it is, and ETH. Yep. Showing that sort of opportunity, but then giving the sort of opportunity to view the charts and things and create this sort of trading pair with these exotic types of tokens, or token pairings.
And what you're looking at here, I think, is like just another example of sort of the more predictable something is, the maybe I don't want to say the less profitable, because I would kind of contradicting myself. But what I mean is that because the volatility for these tokens is relatively constrained. like, of course we get these things, but no one can see these things coming. But across this band, it's relatively stable, and it kind of gets stuck between this like roughly 1.7 and 1.95, which is relatively low numbers compared to what we were seeing on some of the meme tokens we were looking at. So just to sort of come full circle, let's return to the Pepe SHIB chart, and you'll see that the relative volatility, so the percentage difference between the the bottom of this trading channel and the top is actually much higher. And these are the things that you want to be looking at. So this is sort of much closer to a 50% volatility.
Was it SHIB or Floki?
Let's try Floki. Yeah, Floki is great. So you want a lot of this kind of reversion behavior. So a lot of bounces forming these kinds of rectangular channels. But yeah, and again, like, I'm trying to cut this thing through the middle. Obviously, like, I'm trying to ask the question of the simulator, what would have been the performance of a strategy if I managed to trade something well like this? Let's say I missed it. If I separate these things out, or maybe push them a bit closer together, or set just pure limit order. Let's just do something like this. I will set our sell high Pepe. I gotta put in a lot of numbers for this because token's not worth very much. Okay, there, 100K. 0 foot. Yeah, so even on the pure limit order, so with no ranges, selling everything at a single price, and you can see it's just like flipping back and forth like a toggle. Now, in reality, like, if you have a position like this, it won't be instantaneous like that, obviously, because people can chip away at your limit order over time. They don't have to take all of the liquidity or none of it. They can take as little or as much as they need. But we have to make these kinds of assumptions for the purpose of the simulation. But given the the relatively high volumes for these things, I would say that a simulation like this one is very, very trustworthy.
It's incredible, Mark. Thank you so much for doing this with me. I'm really glad that you were able to jump back on, by the way. I know that you were, in between calls, you had to, no, that's okay. No, I appreciate you taking the time right now. Just because these meme tokens are performing so well at the moment, and Corio was saying, like, this is the narrative right now. You see everybody wanting to trade them, and now kind of giving them a different approach to trading them, with this sort of automation is really very valuable. And thank you for jumping back on with me.
You're very welcome.